Dean, we turn on the news, we open a newspaper. Yes, I do like to read physical newspapers. And we're reading about the turmoil in the Middle East, the Iran conflict. And then we sit there, and if you go on X or Truth, you see the post between the president and the Federal Reserve over high interest rates. It's a long winded saying there's a lot of ingredients going into this pie. How is this impacting the oil markets?
Well, so far, we've seen what goes up must come down. Oil went up with the geopolitical tensions. It's come back down. Quietly, some of the impact about increasing deficits, everything that's been happening, on the macro front has added uncertainty that adds to inflation tensions. Sometimes good news is bad news in the sense that if we see economic slowing, that increases the financial markets' expectations of rate cuts. So net, you kind of have these tensions, and we're back in this range for oil of where we started effectively before the geopolitical tensions escalated earlier this month. So, mid $60 per barrel range for West Texas Intermediate crude. But we have to watch, because if the US dollar continues to depreciate and we're down, broadly about 10% so far this year, that's remarkable. It's historic. We've never seen the dollar drop that much in a short period of time to start a presidential term. That also historically is this inverse relationship that then adds a tailwind to oil prices and other commodities too. So net, it's in that range, and we just weathered a pretty historic geopolitical event without seeing a massive spike in oil prices.
Iran, they've been very publicly out there threatening to shut down the Strait of Hormuz. They haven't done it. If they were to do that, what would the impact be on the global oil markets?
That is the longstanding historical threat to global oil supplies, and 15 to 20% of total liquids, crude and products, run through the Strait of Hormuz. So that's the eastern province in Saudi Arabia. It's natural gas exports coming from the United Arab Emirates. It's oil and products coming out of Iran and Iraq as well. So you add it all together, and it's consequential, and a lot of that goes directly to China. It has a reverberation effect for global markets.
So, with that, if you want to call a choke point of 20% of the oil that's coming onto the market, you have a lot of millions of barrels there. Why was there never been a global effort to fortify this strait, just because of the potential impact that it could have on the global economies and most importantly, the global oil markets?
If you went back before the shale revolution, you saw a lot of focus on Middle East military capabilities, defense capabilities. Since the shale revolution, where the U.S. has become much more energy independent, there really hasn't been as much urgency around that. And we just saw, actually, without a physical disruption, a lot of uncertainty threatening, again, 15 to 20% of the global oil supplies, that with historically low strategic petroleum reserves, we're sitting, 400 million barrels, roughly 1984 levels. We got through that with minimal shock to price.
Wow. So we're at 1984 levels. Is there a political desire to increase the levels of strategic petroleum reserve? Or is the Permian Basin continuing to give us enough oil where we don't really have to do that at that time?
Well, this is interesting because under the last administration in 2022, the SPR was sold off almost in half. And this administration has announced a plan to restock the SPR. And I think relative to 400 million barrels, they'd like to have 5 or 6 sitting in there. It's up about 5% year to date, but just based on budget constraints and market conditions, it hasn't added to the urgency to increase it faster. Who knows? They may revisit it, given the fact that we just weathered such a storm geopolitically without having that price shock, with inventory sitting right where they are. And that's confidence, by the way, in the ability, starting with Texas, to produce more and bring it quickly if needed.
How much oil is the Permian Basin producing today?
Well, Texas as a whole is just under 6 million barrels per day, so 5.8 million barrels per day, really to the month, if we're looking at our estimate for June production. By EIA estimates for April, it's been at or near that level, so 5.77 million barrels per day starting in April. The Permian Basin is a little over 70% of the state's oil production, so almost 4 million barrels per day basically coming out of the Texas side of the Permian Basin. If you add New Mexico in, you're adding basically another 2 million barrels per day on that. So it is the most prolific basin. It's divided between Texas and New Mexico and has continued to grow. It really is the hot spot in terms of activity and experimentation with new technology. It is the basin that will continue to lead, most likely here.
We're in a high interest rate environment, and building energy sites is capital intensive. Are we continuing to see the capital flow into the Permian Basin from an investment standpoint to build new energy sites or enhance or automate?
For sure. In terms of electrification, investment through the value chain, the grid in Texas, the ERCOT grid is being expanded to serve West Texas, even more so. And the ability to enhance production in an environmentally responsible way through electrification, that's continuing. From an M&A standpoint, it really is the hotbed of activity of seeing mergers and acquisitions, the growth, and it's because of the layered geology in the Permian Basin and its long-term potential as a source of growth with premium acreage that continues well into the future here. Now, that's not to discount other basins, mature ones. From a natural gas standpoint, you could talk about the Barnett Shale, you could talk about the Haynesville that continues to serve LNG exports as they're growing. The Eagle Ford Basin, in the San Antonio region, has really been a continued source of growth, but it's less dynamic than what we've seen in the Permian historically. So it does grow. It's growing on both the Texas and New Mexico side. The federal land issue that we sometimes talk about is more important on the New Mexico side of it. But the infrastructure to provide it, the investment, the question really from an industry standpoint is with the macro uncertainties we've seen with higher capital costs going in, does it enable the smaller independent producers to invest at the same pace that they have historically?
And then we have the GDP that's slowing. But even though GDP is slowing, global oil demand is projected to reach new record highs of 103.7 million barrels per day in 2025 and 104.7 million barrels per day in 2026. What's driving this demand? And I ask that with the backdrop, and we have data from the New York Federal Reserve, the consumer's getting shaky with the debt levels that they're now reaching.
Yeah, we have to separate out financial markets. And I do think the debt levels, especially U.S. consumers, and we're seeing signs of some cracks in the ability to continue to grow consumption at the same level that we've seen in recent years. But there's no question that oil demand, both domestically and internationally, has held up despite these macro uncertainties. Part of that shows you just how transportation works. Some of it is materials and the fact that plastics and petrochemicals are almost ubiquitous. But to be clear, China, India, developing Asia is still your largest source of growth, both economically and in terms of oil demand. That's the market that most companies want to make sure they serve in the long term. In the developed economies, the U.S. has held up pretty well here in terms of demand. We're actually up year on year. And when we look at deliveries of petroleum through the first half of the year, estimated compared with last year, it's a good story in terms of demand, and it does if it's a leading indicator of growth. So that say that at least physically things have continued to expand.
There's a hot button issue here in the United States, the big beautiful bill. You have against it, for it, and then everybody in between. But if the big beautiful bill, which recently passed the Senate, now on its way to the House, and it passes the House, it's going to go to the president's desk for signature. If the clean energy credits are removed as part of the bill, we potentially see an increase in oil demand in the United States with those credits going away?
Well, the effects of electrification on oil demand have been marginal at best up to this point. It's not as if electric vehicles had massively penetrated. So that trend, that could continue, and the technology appears increasingly fungible from a consumer standpoint. If it's cost effective, it'll continue to grow. So what we can probably say here out of the big beautiful bill is that if you have the elimination of federal tax credits for electric vehicles, that many consumers will probably not be able to adopt or buy them or be willing to buy them when the price is $7,500 higher. So other things being equal, that could slow penetration of electric vehicles. We need to see. I mean, electric vehicles, especially led by China, become more functional, more capable. They lower in price. Over time, you can't say that just a tax credit elimination is necessarily going to change the outcome of the entire industry. But on the margin, for sure, you would see directional slowing here.
China's interesting. We have the Xiaomi car that was introduced today. They're calling it a Model Y, Peter, sub $30,000. It gets really interesting what China's building around electric cars. China's side, the data clearly states, this goes to the IEA, that global oil demand is growing. Now the curiosity has gone. So it's growing this year, continue to grow in 2026. Is there enough global refining capacity to keep up with that demand?
It's been pretty tight for sure, and most of the new capacity in refining and the investment has occurred in Asia Pacific and the Middle East. Because of the shale revolution, you've seen more expansion across the U.S. Gulf Coast in the ability to process the light sweet crude that we have. In fact, to the month in the latest official data from EIA, we've had more Texas refinery processing of crude oil inputs than ever before. So it continues to grow. It grows partly because the domestic demand is there, as well as the exportability and export demand. But it's a strong global sign that not only is that relationship with the economy intact, but the market for it's continuing to grow.
Are we seeing capex going to building new refineries to keep up with this growing global demand?
Well, we have, and especially again from Middle East and Asia Pacific perspectives, they've continued to expand. Whether or not it's overbuilt at any point, most of that has been premised on the fact that electrification would eventually supplant global oil demand. But we're behind the curve on this, right? I mean, in terms of seeing how the global trends have played out, IEA has projected this rollover in global oil demand led by transportation and substitution for electrification. They've predicted that for many years and they continue to double down on it. Now they're saying before 2030 they see a plateau and then a leveling off and a peak in global oil demand. That has yet to see. We haven't actually seen a leveling off in it yet. And if emerging markets, which remain oil intensive, they continue to grow in terms of consumerism, so it's both transportation and the industrial complex that goes with that, the demands continue to grow. That's the evidence so far.
The evidence is there. Ever since you've been very generous to come on once a quarter and discuss the oil markets with me, we've never had one discussion about a slowing market or reaching a plateau. Every quarter you release these wonderful reports and it's the market's growing and growing. And to me, it's fascinating because oil plays a major role in the global economy. And it's not just oil that plays a major role. And you turned me on to this and it really incited me. And now I've gone down research rabbit hole is the natural gas markets. Those markets are growing as well. I'll read some numbers here to you. The global natural gas demand hit a record 148.7 trillion cubic feet in 2024, and it is projected to increase by 1.8% in 2025 and 1.5% in 2026. Now, getting to the interesting part, Dean, you're right on this. 75% of that growth is stemming from emerging markets in developing economies. Wow.
Natural gas is quietly the most interesting story, and it's also, like oil, is geopolitical, right? Because Russia's war in Ukraine really physically affected the Nord Stream 1 and 2 pipelines that otherwise were serving Europe. Europe's both trying to get off of Russian gas and to minimize its reliance on gas, but emerging markets for clean burning energy, for the fact that they can get it with increasing diversity of supply thanks to a growing and more liquid LNG market, it just continues to grow. So we've seen relatively modest prices for natural gas and an abundance of it up until this winter. The previous two had been relatively warm, so the prices were historically low. That's stimulated a lot of demand, and we're seeing a huge appetite, despite all of the trade policy uncertainty. We have a huge appetite for U.S. LNG exports, now the world's largest exporter of it. So I think it's pretty bullish, and we need to see where that can go in terms of market growth.
How are these emerging economies of developing nations using natural gas? Are they using it to grow their economies? Are they using it to build? How are they using it?
Well, it's primarily for power generation and heat. It's really those two things. And again, clean burning compared with using coal. If you have AI-based demand that's growing, and especially in developed economies, natural gas is the power that you can deploy relatively quickly and bring. And for anything from a petrochemical facility or refinery to large factories that need steady supplies of electricity and or heat, natural gas is really your most enduring source there. So again, that relationship to the economy, we talk about the arc of that with oil and how there's diminishing returns that go, but it's still a strong relationship. The relationship with natural gas to global economic growth is even stronger. Historically, it's been closer to 1-to-1. Not quite 1-to-1, but closer than it is with oil. And that reflects the fact that emerging markets have a pretty strong demand for natural gas that's going with their economic growth here.
How is the natural gas shipped, stored, and delivered in these emerging markets? Because I ask because some of these emerging markets, their infrastructure is not top shelf. It needs some work. So how does that work?
Well, you really are talking utility to utility or business consumer to business consumer. And these major industrial utilities will then build the ability, a regasification facility to accept natural gas. And again, it's produced in one nation. Let's say, the United States, it's brought to the Gulf Coast, it's transported. You remove any natural gas liquids out of that, so you're cryogenically freezing and bringing into a liquid form dry natural gas, so pure methane, or as pure as you can. Then that liquid is transported in LNG ships or tankers across the world. The regasification facility takes the liquefied gas and regasifies it. And that plug and play goes directly into pipeline systems in emerging markets.
Are pipelines the key once you get to that market for transporting and distributing the natural gas?
It really is. And interestingly, countries such as China have massively, China has really built out its domestic pipeline network to facilitate using more of that in industry and in homes. So the ability to take that in Europe, as the hub liquidity has also grown, the different import points in recent years, post Russia's war in Ukraine, the ability to take LNG and use it domestically has continued to expand.
So the demand's expanding. We're seeing, I can't tell you how many analyst reports I'm reading on a weekly basis around natural gas data centers. Natural gas data centers. That's an analyst report, but you get the real reports because you're working in the oil and natural gas industry. Are you seeing this demand for natural gas to power AI data centers that I'm seeing here in the Wall Street analyst reports?
It's the potential, and logically, again, if you're deploying a data center and you need electricity and a grid doesn't naturally have a lot of excess capacity sitting on the grid, you will need to co-locate some sort of power generation facility along with it. And wind and solar are useful there, in terms of low-cost fuels, but they also bring intermittency that data centers tend to have more steady 24/7 flat-out demand, both in terms of processing with generative AI or training of data centers. You have a continuous need. So latency, where you put it, the amount of energy that goes into it, there are a lot of concerns, but natural gas really is the one thing you can deploy relatively quickly. It can be procured. You can put the whole supply chain from production through processing, through transportation. You can get firm commitments for storage, for transportation, and the gas commodity itself relatively quickly in ways that would be much more complicated if you're trying to, for example, build a nuclear facility, as some of the hyperscalers are. That's a more next decade solution. So at least in the short run, it's pushing more of that. Now, that said, in Texas, so we're looking to the most current month, we have 4.2 billion cubic feet per day in the latest data as of April for power generation from natural gas. Last year, it was 4.3. So it's not dominated entirely by data centers. Part of this is just the fact that it's seasonal, and natural gas is always seasonal. That's for industrial demand specifically, but we need to see where that goes.
So historically, it's seasonal. You and I have talked on past episodes where if it's going to be a cold winter in Europe, okay, demand seems to go up versus a warm winter. So do you see for the foreseeable future that it stays seasonal, and then as these data centers are built, and you're based in Texas, and let's use Oracle because they're very publicly building a very big data center in Texas. As the Oracle data center ramps up and other ones ramp up, does it move away from seasonal, or is it just that the global demand for natural gas will always remain seasonal?
Well, I would think of it as the seasonal element is still important, but the baseload element of it is continuing to grow thanks to industry growth led by data centers coming in. And to be clear, the contracts that get in place to continue to develop that, once you put these plants in place, that becomes part of your supply mix that makes it all possible to locate data centers where you will. Right now, Texas competes with states like Virginia and Ohio primarily for data centers. You can put them elsewhere, but those are your top three states in terms of the backlog of construction of them. Virginia, Northern Virginia in particular, has the most in the nation. Ohio is number two, and Texas, in terms of that construction backlog, is number three. So you're talking on the upside of like 54 to 5 billion backlog in terms of construction of data centers in Virginia, compared to 18 to 19 billion dollars currently for Texas. That may continue to change, but it's based on where you need it, what infrastructure you have to serve it, the workforce to serve it, but also power availability is one of the key ingredients. in those locational factors for data centers.
From an economic standpoint, the key common denominator across all this is job creation. Those sites are creating jobs, they're employing people. That's the key there. I'm curious, you said to colo the natural gas. How does that work when natural gas is co-located at a location, such as a data center?
Well, you would apply so that you're not necessarily having to become a utility, but you have the term is behind the meter, but you're setting up your generation capacity on the same site or adjacent to where you have the need for it. So that can be a data center, it can become another or be another kind of industrial facility. But that's the way that if, especially in West Texas, for example, where maybe your transmission constraints exist, you can't necessarily build and connect a new large load facility instantaneously. The way to get around that is to bring your own power solution. And that's what we've seen. We've seen a lot of proposals, and it's almost a real estate play of setting up a facility, trying to secure power arrangements to go with it, and then negotiating with hyperscalers like a Google and AWS and Amazon Web Services or others to take that facility or most of the capacity in it. But again, it's the power solution together with the other infrastructure to make that happen.
The bottom line is natural gas will play a role, if you want to call it, in the mix of powering a data center going forward. Is that a fair statement?
It'll not only play a role for the near term, it is the main nexus for getting a data center off and going. So unless you have a lot of excess power sitting on the grid, and that's being sought out real time anywhere that spare power exists, that capacity, you're seeing a lot of interest in the market in building data centers in places like if whether it's Dallas as a center for that or the Houston area to try to co-locate with where you have minimum latency, a good workforce, the ability to locate it with fiber connections, all the things that together make it feasible to expand the data center connections. I should put a plug in for the University of Texas Bureau of Economic Geology here. I've collaborated with their team. We came up with a research paper. I'm just a contributing author to it, an editor of it. But that work looks at all the locational factors of data centers, including power availability, and really maps it out.
We're going to share that report. Is the report public now?
It is.
All right, so we're going to share that here in the notes. And what Dean described with the data centers is why one of the main reasons we have them on every quarter, because the oil and natural gas markets play a role in automation. Because without the data centers, we're not getting the automation. Without the natural gas, we're not getting the data centers. Without that, we're not getting the automation. So it plays a really critical role there. So thank you for shedding that light there, Dean. I want to dive into some of the numbers here on natural gas from a production and consumption perspective here. The United States has produced 38.3 trillion cubic feet of natural gas in 2025, but yet it only consumed 33.3 trillion cubic feet of natural gas. Is the excess natural gas getting exported? Is it getting stored? What's happening with the excess capacity?
There's always seasonal storage, but the vast majority of that is exports. And we have become, thanks to LNG, the largest exporter of liquefied natural gas in the world. I guess technically the only country that has a larger gap between supply and demand is Russia, but they rely a lot on pipelines to be able to export the volumes that they do. We have about 6 billion cubic feet per day of pipeline capacity going south to Mexico. We also have pipelines that go back and forth. We're at times a net importer from Canada for natural gas, but it's the LNG exports rising to number one in the world, continuing to grow. And there's really been an enduring demand, especially from emerging markets, to have that source.
Where is the United States exporting that natural gas to? Is there a pattern there?
Well, it's fluctuated. Historically, it used to be Asia Pacific. Again, India, China, Japan, Korea, Taiwan taking this. And then since Russia's war in Ukraine, we saw earlier this year as much as 3/4 of Texas natural gas exports, and this generalizes to the U.S. since it's the majority of it, going to Europe. So Europe taking a lot of it. Now, in the latest data, if we're going to the month, and we're looking at trade data through May, we do start to see that Asia Pacific's coming back. It's still secondary to Europe, though. So Europe's demand and what happens with the future of Russian gas and whether there's a resolution of Russia's war in Ukraine, those are key variables that will affect natural gas markets on a global scale.
And looking at it from a global perspective, globally, who's the largest exporter of natural gas?
Well, for total gas, it's still Russia, but for LNG, the U.S. is number one, and it's thanks to liquefied natural gas.
Wow. And do you see that exports of LNG from the United States, is that a growth market for us from an export perspective?
Absolutely, it's continuing to grow. We would say by EIA, Energy Information Administration estimates in the short-term energy outlook, we would be adding 1 to 2 billion cubic feet per day of exports per year between now and 2026. And then beyond that, we need to look at the slate of projects that come to market. But this administration has pledged to increase the speed of permitting and infrastructure that would enable more of those exports over time. So that enables us to serve global markets more efficiently and more cost effectively.
Okay, well, that's healthy then at the end of the day. So now, curiosity hat goes on. Where is most of this natural gas in the United States coming from?
Well, Appalachia is a really important basin, so that's Ohio, Pennsylvania, and West Virginia, but more than all of the growth, as that actually declined last year, we've seen the Permian Basin in Texas as the number one provider in terms of the growth of it. So Texas is your main source of natural gas. You're seeing a lot increasingly come out as associated gas from the Permian side, excuse me, the New Mexico side of the Permian Basin as well. But the market's bet right now, if we're looking at futures prices between now and next winter, the term is in contango. So spot prices today are lower than futures prices going out to next winter. And that's an expectation by the market of a tightening market, and also an assumption that if the conventional wisdom is that oil growth would, especially from the Permian Basin, would slow, that there would be less associated natural gas coming with it, which would, other things being equal, mean that you have to have more dedicated drilling for dry natural gas in the United States. And the place that you would get that primarily to serve LNG exports would be the Haynesville Formation, which crosses East Texas and Louisiana. So in terms of rig activity, yeah, we've seen kind of steady amounts of natural gas drilling. The market is expecting that tighter market to come, but that's where it's coming from. It really is the Permian Basin that's leading the growth, although the other basins remain important. The Permian Basin is really your source of looking toward productivity trends, infrastructure trends. If we could just get more pipelines out of West Texas, if the market certainty is there to have that happen, the gas is available for export.
From a pipeline perspective, is that just a permitting issue or is it a demand issue? What is that?
That's really the assurity of having more of the LNG export facilities, which is a permitting issue on a federal level, put in place. If that and the market assurity to go with it is there, then you'll see more parties able to build intrastate pipelines from West Texas to serve the Gulf Coast. And again, the difference, we often look at Henry Hub prices. Henry Hub, Louisiana is your main benchmark, right? But over this year, when we've looked at the Waha Hub, WAHA in West Texas, we've seen prices negative at times, and there's routinely a $1-2 per million BTU difference between Henry Hub and that price in West Texas, where at times you're literally paying people to take natural gas away. So you care about the oil growth, right? And you're trying to find a market for natural gas, but it's been pipeline constrained. That's gas ready for export, ready for market, if we just have the infrastructure to take it.
Well, I'm going to sound like the president of the United States now. If the interest rates came down, perhaps you could have the pipelines. And that's not my statement. That's a statement from the president of the United States. Back to oil and gas markets here. What is it about the geology of the Permian Basin that has an abundance of oil and an abundance of natural gas? What's it in the geology that enables this?
Well, it's the depth and the quality of the resource, the shale resources. And unlike some other shale plays around the world that tend to be thinner, this has many, many layers of layered. The term in the industry is play, but different levels of geology that you can tap into, that you can hydraulically fracture, and that you can recover from. So it's not just, think of it as a layered sandwich with different things that you can bite into over time. And that's been enduring, and there's been nothing else like it in the United States to that quality and depth that's enabled the continued discovery and rediscovery of how to develop this. And by the way, in the last legislative session, the state of Texas passed new legislation for the re-stimulation of mature wells. So it is possible to have an incentive to go back to the Barnett Shale, for example, which was the very origin of dry natural gas, almost completely dry natural gas shale development, and start to redevelop those wells economically. So if that technology takes off, if the cost to recomplete an existing well using existing infrastructure, if those come down, that's potentially another leg to the shale revolution.
It's another leg that's going to be a positive leg. And from our world, from the autonomy world, the companies operating the Permian Basin are actively investing in automation and autonomy. Atlas Energy has deployed fully driverless trucks with Kodiak Robotics. They have also an incredible autonomous sand belt that goes, I think it's the largest in the world. So there's a lot of investments being made in infrastructure, being made in automation and technology. And because when the Permian Basin continues to shift oil into natural gas, it's good for the U.S. economy, and it makes the United States energy independent. Dean, we love having you on every quarter. I love your insights into the oil markets. What do we need to look for in the oil markets over the next quarter till we have you back on in September?
Thanks so much, Grayson. I really enjoy being here in these conversations each quarter. We always take a world tour, so I enjoy it. More geopolitics, we got to continue to watch that. Global refining margins are important, so we're going to watch that for oil markets. The thing that I always look to that's more inside baseball is productivity trends. So both rig productivity, especially in Texas and the Permian Basin, the reactivity to go with it. But we've seen, despite slippage of that the productivity is really the thing to watch. So that pace, how it continues, and then on the economic side, the demand side, we've had multiple threads here we've discussed about China and developing Asia. So we need to see how the macroeconomy, these trade relationships affect continued economic growth, especially in emerging Asia. And if that continues on track, or at least largely intact, then there's a pretty good chance that we're going to see enduring oil and gas demand growth, and Texas' ability to supply it really is the key there.
Texas will continue to supply. They have a great governor. They have a very brilliant economy there in Texas. That's, I want to say for the record, is now diversifying, which is really good for the state. And every quarter, yes, we're going to continue our world tour, but who knows where we're going in the world next quarter? It depends on what happens. Until next quarter, the future is bright, the future is autonomous, the future is natural gas powered AI generative data centers. Dean, as always, thank you so much for coming on the road to autonomy.
Thanks, Grayson. Always enjoy it.